Hey everyone, welcome back to Corporate Decoder, the place where we dive into the juicy details of corporate filings and figure out what is really going on behind those fancy numbers and legal jargon. Today we're dissecting American Exceptionalism Acquisition Corp, A's latest quarterly report, and let me tell you, this one has some interesting twists, especially when it comes to their initial public offering and how they're setting themselves up for a future business combination. Forget the boring stuff. We're going straight for the financial jugular. So what exactly is this document? It is a quarterly report, a rundown of a company's financial health and activities over the last 3 months. Think of it as a mid-year checkup for a business. American Exceptionalism Acquisition Corp, A or AEACA as we'll call them, is a blank check company also known as a Special Purpose Acquisition Company, or SPAC. Their main goal right now is to find another company to merge with, essentially buying a ticket to the public markets for that target company. A quick snapshot shows they have a considerable number of shares out there, with Class A shares for the general public, and Class B shares often held by founders and early investors. The key thing here is that these numbers tell us about the ownership structure right before and after their big IPO. Let's jump straight into the numbers. On their balance sheet as of the 30th of September 2025, we see a few key things. They have cash and cash equivalents totaling over $882,000. That is the operating cash they have on hand. They also have a significant amount, over $345 million, held in a trust account. This trust account is super important for SPACs. It holds the money raised during the IPO, intended to be used for that future business acquisition. There is also something called marketable securities held in trust account, which is the bulk of that $345 million. This is where the IPO money is parked, usually in safe, low-risk investments like government securities or money market funds. It is essentially a big pot of money waiting to be deployed. Now, this line item is critical for understanding how SPACs work. It says, Class A ordinary shares subject to possible redemption. This means the holders of these shares, the public investors from the IPO, have the right to get their money back if the company doesn't find a suitable business to merge with within a certain time frame. They're essentially giving these investors the option to bail out and get their initial investment back, which was around $10 per share. This is a huge factor in how the company's financials are presented, making these shares look more like a liability until that merger happens. And then we see shareholders' deficit for the period ending the 30th of September 2025. This is a negative number, around $19.8 million. This usually happens with companies that are still in their early stages, like SPACs, before they've really started generating revenue from an acquired business. Their expenses, like formation costs and offering costs, are higher than any income they might have at this point. Looking at their statement of operations for the period from their inception in July 2025 through September 2025, they incurred a net loss of over $10.4 million. Not surprising for a company that is just getting started and is focused on an IPO. A big chunk of that loss comes from advisory fee expense totaling over $10.3 million. This is essentially a fee paid to advisors likely related to their IPO. Then there are general and administrative expenses of about $111,000, which cover the day-to-day operational costs. On the income side, they did earn some interest, about $37,000 from those investments in their trust account. So while they're losing money overall, they're at least getting a small return on the money they've raised. Notice the weighted average shares outstanding for Class B shares is significantly higher than for Class A shares. This is typical for SPACs where the founders and sponsors get a large chunk of shares, often with different voting rights or conversion terms. There was a cool event that happened on the 25th of September, just before their IPO. The company issued more founder shares to the sponsor, Accession Sponsor LLC. This increased the sponsor's total holdings. It looks like they're beefing up their stake. This is a really important detail. Some of those Class B shares, about 1.9 million, were initially at risk. They could have been forfeited if the IPO underwriters didn't fully exercise their option to buy extra shares. But guess what? The underwriters bought them all. So those shares are now safe and sound in the hands of the founder. This shows confidence from the underwriters and secures those shares for the sponsor. The statement of changes in shareholders' deficit explains how the equity section of the balance sheet changed. It shows the initial issuance of Class B shares to the sponsor, the sale of private placement shares, and how the net loss impacted the overall deficit. We see this line item, accretion for Class A ordinary shares to redemption amount. This is basically accounting for the fact that those redeemable Class A shares are presented at their redemption value, which is expected to be around $10 per share. The difference between their initial accounting value and this redemption value is what is being accreted, or added over time. This adjustment hits the additional paid-in capital and accumulated deficit. They also sold 175,000 private placement shares at $10 each, bringing in $1.75 million. These are typically sold to the sponsor or other select investors before or during the IPO, often with fewer restrictions than public shares. Now, let's look at the cash flow statement. This shows how money moved in and out of the company. Their net cash used in operating activities was about $320,000. This makes sense given the net loss and the adjustments for things like formation costs and changes in their short-term assets and liabilities. The big cash outflow comes from investment of cash in trust account, a whopping $345 million. This is the money from the IPO that they put into that trust account we talked about earlier. On the financing side, they had substantial proceeds from sale of shares net of underwriting discounts paid, totaling over $344 million. This is the IPO money minus the fees paid to the underwriters. They also got proceeds from selling those private placement shares and from a promissory note. It is interesting to note the non-cash activities. For example, offering costs included in accrued offering costs shows about $125,000 of costs that are recognized as expenses, but don't involve an immediate cash outflow. Digging a bit deeper into the notes, we learn more about the company's structure. They were incorporated in the Cayman Islands on the 11th of July 2025. Their whole purpose is to find a business to combine with. They haven't even identified a target yet. The sponsor is Accession Sponsor LLC. This confirms the IPO happened on the 29th of September 2025, raising a massive $345 million. They also sold those 175,000 private placement shares for another $1.75 million. They are committed to using most of this money for a business combination. The cost of putting on this IPO was significant. Over $11 million went towards underwriting fees, both paid up front and deferred, and other offering expenses. That is a hefty price to go public. The report also addresses their liquidity and going concern. They're saying they have enough cash for the next 12 months, primarily through their operating funds and potential loans from their sponsor if needed. However, they also acknowledge substantial doubt exists about the company's ability to continue as a going concern if a business combination isn't achieved within their set timeframe. This is standard language for SPACs, highlighting the risk if they fail to find a target. Under their accounting policies, they note they're an emerging growth company. This means they can take advantage of certain regulatory relaxations, like not having to comply with auditor attestation requirements for internal controls, as immediately as larger companies. They've also elected not to opt out of the extended transition period for new accounting standards, meaning they can adopt them later, similar to private companies. This can make comparisons with other public companies a bit tricky. You'll see a detailed explanation of those redeemable class of shares, because these investors can get their money back. These shares are presented as temporary equity outside of permanent shareholders' equity. The value of these shares is adjusted to reflect their potential redemption value. This section reiterates the details of the IPO, confirming the sale of 34.5 million class of shares at $10 each, plus the underwriters over allotment. This confirms the purchase of 175,000 private placement shares by the sponsor at $10 each. It also details the agreements made by the sponsor and early investors, including waiving certain redemption rights and agreeing to vote in favor of a business combination. This is where we see the details about those founder shares. The sponsor initially contributed $25,000 and received over 12 million founder shares. Then, an additional 2.4 million founder shares were issued through share capitalization. So, the sponsor holds a total of nearly 14.8 million founder shares. They also mention assigning 300,000 founder shares to 2 independent director nominees in exchange for their services. The value of these shares is calculated at fair value. The sponsor also provided a loan up to $2 million to help with IPO expenses. As of the 30th of September 2025, about $122,000 had been borrowed under this non-interest bearing note. This loan was paid back shortly after the IPO closing. They mention the possibility of working capital loans from the sponsor or affiliates, which could be convertible into shares of the post-business combination entity. No such loans were outstanding as of the 30th of September 2025. This section discusses general risks and uncertainties, including geopolitical events like the Russia, Ukraine and Israel, Hamas conflicts, and potential changes in US trade policies and tariffs. These factors could impact their search for a business combination and the overall economy. Here they lay out the details of the underwriting agreement. The underwriters had an option to buy more shares, which they exercised. They were entitled to a cash underwriting fee and a deferred underwriting fee of about $10.35 million, which is contingent on the successful completion of a business combination. There is also an advisory fee equal to 3% of the gross IPO proceeds, payable upon the closing of a business combination. This fee was already recorded on the balance sheet as earned. This section details the different classes of shares. They have authorized preference shares, Class A ordinary shares, and Class B ordinary shares. The Class B shares have specific conversion rights tied to performance milestones after a business combination. They confirm that their marketable securities in the trust account are valued using level 1 inputs, meaning they are based on quoted prices in active markets for identical assets. This is the safest and most reliable way to value those assets. The company reports only one operating segment. The chief operating decision maker reviews the company's performance as a whole. They look at things like general and administrative expenses and interest earned on the trust account investments to manage resources and assess performance. This section is usually for events that happened after the reporting period, but before the financial statements were issued. They state that no other subsequent events required adjustment or disclosure beyond what is already mentioned. Moving on to management's perspective, they reiterate that they are a blank check company focused on a business combination. They expect to continue incurring significant costs and can't guarantee they'll find a suitable target. Management explains that they haven't generated operating revenues yet, and their activities have been limited to formation, preparing for the IPO, and searching for a target. Their only income comes from interest on the trust account. They acknowledge the net loss and its components. They discuss their liquidity, which was primarily funded by the sponsor before the IPO. After the IPO, the significant proceeds are in the trust account, and some funds are held outside for operations and due diligence. They acknowledge the potential need for additional financing and the going concern doubt if a business combination isn't achieved. They state they have no off-balance sheet arrangements currently. They highlight their commitment to that deferred underwriting fee and the advisory fee, which are contingent on completing a business combination. For critical accounting estimates, they state that as of the 30th of September 2025, there were none to disclose. This is common for companies at this early stage. Not required for smaller reporting companies, so they skip this. They report that their disclosure controls and procedures were effective as of the 30th of September 2025, meaning they are capturing and reporting information as required. No changes in internal control over financial reporting occurred during the quarter. No legal proceedings to report. They refer back to their IPO prospectus for risk factors, stating there have been no material changes. This section details the IPO and private placement again, confirming the use of proceeds and the funds placed in the trust account, as well as the offering costs. Finally, the exhibits section lists all the supporting documents, including certifications from their principal executive and financial officers, which basically attest to the accuracy of the report. So, what is my take on American Exceptionalism Acquisition Corp? Well, they're a classic SPAC right now. Their financial statements clearly reflect a company in its pre-operational phase, focused entirely on raising capital and finding a business to acquire. The good news is they successfully completed their IPO, bringing in a substantial amount of money. The trust account is well funded and the sponsor seems committed, even issuing additional shares and providing loans. However, the major risk inherent to all SPACs is whether they can actually find a suitable business to merge with within their time frame. The going concern note highlights this uncertainty. The redemption feature for Class A shareholders also means that a significant portion of their IPO proceeds could potentially be returned to investors if a deal doesn't materialize. The significant advisory and underwriting fees also mean that while they raised a lot of money, a substantial chunk of it went to the deal makers. From a shareholder's perspective, the key is the success of that future business combination. Without it, the value of their investment is directly tied to that redeemable amount, which is around $10 per share, plus whatever interest is earned. The company direction is clear: find and merge with a business. Their strength lies in their substantial IPO proceeds and the experienced sponsor. Their weakness, and the biggest risk, is the execution of that merger. Opportunities are tied to finding a high-growth target that can benefit from the SPAC's capital and management's expertise. In conclusion, AACA is in the very early high-stakes game of SPACdom. Their financial health is currently defined by the funds in their trust account and post-IPO operational costs. The real story will unfold as they announce a business combination. Until then, it is a waiting game with inherent risks and the potential for significant rewards if they nail that merger. Alright, That is our breakdown of American Exceptionalism Acquisition Corp. A's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into corporate filings that actually matter. Don't forget to check out the Discord community linked in the description for more exclusive content and discussions. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.